Hello students, welcome to AffairsCloud. My name is Shashmita. We have an app by the name CareersCloud which you can go and download through the Play Store. Once you have downloaded the application, you will easily be able to log in using your Gmail ID. And once you have logged in, you will be redirected to this page where you will be getting this UI. And there will be option for home, all courses, my courses and download section in this application. You will be getting multiple PDFs, multiple content on daily basis that will be enhancing your learning. Under Crack Current Affairs, you will be able to see multiple options. First one is Current Affairs English. We upload the day-to-day basis news in the English format. And apart from English PDF, we also provide them in Hindi format. And this banking awareness, we upload a PDF every month. So this PDF will contain the banking news, banking and the finance news of that respective month. And Current Affairs Exam PDF will have two categories. One is that most important news of that particular month will be uploaded in this Current Affairs Exam PDF. And also Exam Perspective PDF will also be uploaded. And next is Special CA. This will contain Union Budget, Economic Survey, and also the most important events that had taken place globally as well as nationally. And next most important is topic wise. So the entire news of that particular month will be segregated into different topics. And in order to recollect whatever you've read, we also provide you with topic wise quizzes. Apart from that, we also provide state current affairs. Now, here if you see, we provide you with the day-to-day PDF, and this we provide you with the weekly PDF. So that particular week news will be compiled into a PDF and in question and answer format in English and will be uploaded here. And to enhance your learning, you can also, to enhance and strengthen your learning, you can also attend the quiz. Here we provide you with the entire news of that particular week. But here we take the top 60 most important news and we upload it in this PDF in question and answer format. Apart from weekly, we also provide you the monthly ones. This PDF will contain detailed view of that particular month news, and this will have a brief format of the same news. This will be in the form of a question and answer format, and this will have the top 100 question and answer of that particular month. We also provide you with the PIB news on a day-to-day basis, which you can go and read in these particular tabs. Apart from that, we also provide the Union Budget and Economic Survey. You can also attend you can read after reading the PDF. You can also go and attend the quiz. This is available in the Special CA category. We also provide state level current affairs. So this will be very helpful for students who are preparing for state level exams. For example, if you are preparing for Tamil Nadu state level exams, then you can click this tab and you will be able to see all the current affairs or news related to Tamil Nadu. Apart from that, we also provide PDF from the exam perspective. Suppose you are preparing for RBI assistant mains, then this tab will contain 5 to 6 months of current affairs, which has high probability of being asked in RBI assistant mains. Similarly for SBI PO, RRB PO, clerk mains, all these are being given under this section. And also we provide separate content-wise, topic-wise current affairs like national affairs, government schemes, international affairs, banking and finance, economy and businesses, MOUs and committees and meetings. All these different types of news are segregated in these particular categories. Hello students, welcome to our new initiative. In this initiative, we will be uploading the weekly current affairs on banking and finance section. So this will be uploaded on every Monday. And so on the whole, per month, you will have totally 4 videos related to this topic. And apart from just providing you with the banking and finance news, we also provide you the conceptual explanation so that this will enhance and also strengthen your knowledge about these topics. Today, we will be covering January 1st week banking and finance awareness news. Moving to the first news. RBI released the report on trends and progress of banking in India for 2003-2024. This is a very, very important report, not only for the regulatory body exams, but also for the banking exams. We know that the banking exams are becoming very competitive. So, any report that's been released by RBI is very important for the banking as well as for the regulatory exams. So, this Reserve Bank of India has released this report under the Section 36 Part 2 of the Banking Regulation Act 1949. The performance of the banking sector, that is in commercial banks, cooperative banks and non-banking financial institutions, all the performance have been mentioned in this report. The first one is banks' profitability improves for 6th year in a row in the financial year 24. So the profitability of the commercial banks in India increased for the 6th consecutive year in the year 2003-2024. The return on asset was 1.4%. and the return on equity was 14.6%. Return on asset means the net income by total assets. We know that in the banking terms, the asset means it's nothing but the loans. So here it is the loans, and income, it is the interest, the charges like the processing fees. So all these are an income of the bank. So when you minus the expenses, you get the net income. So expenses here, it includes the operational cost. You have to pay salary, right? And also you get interest on your loans. At the same time, you have to pay the interest on the deposits also. So when you remove everything, you get the net income. So return on asset is net income by total assets. Similarly, return on equity is the net income by the shareholders' equity. This is the difference between both. Here return on equity, here it is the shareholders' equity. Here the return is on the assets. So return on asset is 1.4% and return on equity is 14.6%. Next is, in order to close the credit deposit gap, the banks had to raise their deposit rates and borrow money at higher interest rate. We know that the credit deposit gap was existing and it was a big problem to the banking sector, which means that the credit was more compared to the deposit. The credit was growing more compared to the deposit. If you see, compared to the previous year, if the credit was growing at 10% per annum rate, but the deposit was growing only at 5%. See, we know that banking, they work, how do they work? They get the deposit and from that deposit, they provide loan. If the deposit itself, it's not growing that much, but the loan is growing at a higher rate, then they will have a funding crunch. They will not have money to fund the loans. That is the issue with this credit deposit gap. That is the issue with this closed credit deposit gap. So in order to reduce this gap, what banks had to do is raise the deposit rate. So when the deposit rate is increased, then the customers will be attracted to the deposits and they will deposit more. And next is interest expense to income ratio increased to 57.4% in the financial year 24 compared to 52.2% in the financial year 23, leading to a slow growth rate in the operating and the net profit. Next is net profit of the scheduled commercial banks increased by 32.8%, that is to 3,49,603 crore during the last fiscal. At the end of March 2024, if you see, there are 12 public sector banks, 21 private sector banks, 45 foreign banks, 12 small finance banks, 6 payment bank, 43 regional rural bank and 2 local area bank. So totally there are 137 scheduled and 4 non-scheduled bank. So scheduled bank are nothing but they are mentioned in the second schedule of the RBI Act. When they are not mentioned in the second schedule of the RBI Act, it is called as a non-scheduled bank. Next is the gross NPA. So the bank's gross NPA hit 13-year low. So gross NPA and net NPA. There are two things. So when you make the provisions, then a gross NPA becomes a net NPA. That is when you take money from your profit of the bank and provision the bad loan, then it becomes a gross NPA becomes a net NPA. So the gross NPA or the proportion of bad asset loans to total loans declined to a 13-year low of 2.5% at the end of September 2024 from 2.7% at the end of March 2024. So this is a very good news. It has declined to a 13-year low and now it is 2.5% as on September 2024. So if you see, gross NPA declined by 15.9% year on year, that is to 4.8 lakh crore as on March 31st, 2024. Then the net NPA fell to 0.5% of the total loans in September 2024 compared to 0.62% in March 2024. The highest gross NPA was observed in the agriculture sector, that was around 6.2%, and the lowest was observed in the retail loan sector, that is 1.2%. This data is very important. Remember, it is 2.5%. Next is about the frauds. The banking frauds in India, it rose to 18,461 cases in the first half of the financial year 25. So if you see the number of bank frauds, it increased around 26% year on year. In April to September 2024, that is to 18,000. So compared to the April to September of 2023, and here April to September of 2024, 27% has been increased. But if you look at the amount involved, it has increased more than 8 times. So from 2,623 crores, the first half of the financial year 24, now it is currently 21,367 crores. So this is April to September 2024 and this is April to September 2023. So compared to that, it was 2,623, but now in April to September 2024, it is 21,367 crores. So here 21,367 crores, and here it is 2,623 crores. So if you see, the maximum fraud was observed in the card or internet. So 13,133 frauds were observed under the card or the internet category. So if you see, out of the entire fraud types, around 44% was done in internet and card. So around 44.7% the modus operandi was internet and card, and around the total fraud cases, private banks had reported 67.1% fraud cases. So here, you have to remember the trend here. So remember that the private banks had reported the most number of fraud cases, and here remember that internet and card were the instruments through which the fraud happened the most. So these type of trend you have to remember. It's okay to not remember the numbers, but remember the trend. It is very important. So this is the penalty. So total penalty that was imposed on the banks, if you see, it has doubled compared to the previous year. So the previous year, financial year 23, it was 40 crores, but financial year 24, it has been increased to 86.1 crore. This is an important number. Remember, it is 86.1 crore. It has more than doubled compared to the previous financial year. Next is the capital adequacy ratio of the scheduled commercial banks was 16.8% at the end of the September 2024. So tell me, what is the capital adequacy ratio that the banks have to maintain as per the RBI norms in India, and what is the capital conservation buffer that they have to maintain? So this is well above the actual limit. So tell me the CAR and CCB in the comment section. Next, if you see the balance sheet, that is consolidated balance sheet, it has increased or widened by 15%. But the share of the public sector banks in the balance sheet has been reduced to 55%. And in contrast, private sector banks' share in the balance sheet has increased to 37.5%. So if you see, though the majority, if you see, it is held by public sector banks, but compared to previous year, the share has reduced to 55 and private sector share has increased to 37. Next is the liquidity coverage ratio, to ensure that the banks have enough high liquid assets that can be immediately converted into money, into cash. So high liquidity coverage ratio is calculated as high quality liquid assets divided by the net cash outflow. So for the next 30 days, if you have a net cash, if you need a net cash outflow of 300 crores, then you have to ensure that you have a high quality liquid asset of at least 300 crores. So as per the RBI norms, the liquidity coverage ratio should be 100 crores. That's it. That is, it must have a high quality liquid assets to cover the net cash outflow for the next 30 days. So if you see, previously in September 2023, it was 135.7% and now it has been reduced to 138.5%. Next is over 600k loans worth rupees 27,000 crore was dispersed on the ULI platform, that is Unified Lending Interface platform. So if you see, it has provided around 6 lakh loans worth rupees 27,000 crores, and among the 6 lakh, 1,60,000 loans was provided to the MSMEs. The amount is 14,500 crores. So now if you see, a lot of segments are included in this Unified Lending Interface like Kisan Credit Card, Digital Cattle, MSME, Housing, Personal, Tractor. So various 12 loan segments are now included, are now available on this platform. Now, what is this Unified Lending Platform? Say there is a farmer A. Okay, he is a dairy farmer. He wants a loan. So he visits to the nearby bank. The bank manager hands over this application form to the customer A. Looking at the application form, the customer is worried, the farmer is worried because he does not have the documents, or does he know to arrange the documents. So he is quite sad and he gives his KYC documents that he already has to the bank manager. The bank manager enters the KYC and checks his credit history. But unfortunately, since he hasn't taken any loan previously, there is no credit history. So there is no credit history. He does not have, or he does not know how to arrange the documents for this loan purpose. So now he thinks how to process the loan. Here comes the ULI, the Unified Lending Interface, to the picture. So if you see, ULI, it is a revolutionary credit digital public infrastructure that brings together data providers and lenders to serve the needs of a citizen like person A on a single platform. So here if you see, the data providers are GSTN data, the land records is provided by the state government, the eKYC, PAN verification, so the satellite images. So all these are data lenders. So all these data providers, they are clubbed into a one single place because they are all disintegrated. They are all isolated in different places. So it is very difficult for banks to get data from this isolated data centers. So what happens is that these data providers are brought into a single place, and here now these institutions, these financial sector institutions connect to this data providers and collect the data of the customer from the data provider after getting the consent from the customer. So important thing is the consent from the customer is important. Only after that they can collect the data of the customers from these data providers. So it allows the financial sector players to access the data by connecting in to the platform with a plug and play model. So if you see now, the bank manager connects to this ULI platform. So in order to find the farm area, what he does is that he gets the data from the land records. Next is to collect the irrigation pattern. He gets the picture from the satellite image. And in order to collect the income from the income of the dairy business, what he does is that he connects with the milk pouring and cash flow. So generally the dairy farmers, they collect the milk from the cow and they go and deposit with the society. So the society will have the data of this. So from that, the bank manager will collect the data. So this is how the entire data is processed from the data providers. Next, the bank manager analyzes the data and then processes the loan using this data. Next is private banks outrun public sector piece in the priority sector lending. So we know that the priority sector lending is a must. So if you see for scheduled commercial bank like private banks, public sector banks, and also foreign banks having 20 branches or more, we have to have a 40% of priority sector lending. They have to achieve at least 40% of priority sector lending. It is a must. When they do not achieve this 40%, say there is a bank A, it has achieved more than 40%. Okay, but there is a bank B which has achieved only 35%. So it is in short of 5%, right? What it will do that since bank A has achieved more than 40%, bank A will issue priority sector lending certificates. So these certificates are against the priority sector lending loans. So bank A will generate these certificates and will sell this to the bank B. So bank B will buy these certificates from bank A and it will fulfill the target. So after buying these certificates from the bank A, now bank B will increase. Bank B percentage would have increased to 40% and now it has met the target set by RBI. This is the purpose of the priority sector lending certificates. So if you see, the private banks have met priority sector lending targets, including sub-targets for the major heads, particularly in agriculture. So if you see, they have sub-targets also. So agriculture, if it has a target of some, say suppose 18%, then small and marginal farmers. So this is a sub-target. So both the target as well as the sub-target has to be met. And they have done better than the public sector banks. The total trading volume of the priority sector lending certificates increased to 26% in the financial 24, primarily led by the PSLC general. Among the 4 PSLC categories, the small and marginal farmers category registered the highest trading volume. So in the past 5 years, the private banks have emerged as the major sellers of the priority sector lending certificates, accounting for 49% of the total sales in financial year 24. For the public sector, private and the foreign banks, the target is 40% of the adjusted net bank credit, and if you see for small finance bank and RRB, it is 75%. So we saw that there are 4 types of PSLC. One is agriculture, the other one is small and marginal farmers, next one is micro enterprises, and the last one is PSLC general. Next point is NBFC lending surges 18.5%. So if you see, the RBI report showed that the loans and advances of the non-banking finance institutions, it increased by 18.5% compared to the previous year of 17.4%. So NBFC have sourced funding from the banks. Around 42% of the total funding is from the banks and also from the non-convertible debentures, commercial paper borrowings and external commercial borrowings. We know that NBFCs, other than deposit taking NBFCs, they cannot borrow money from the depositors. That is, The customers cannot go and deposit other than NBFCs that are deposit NBFCs. Only the deposit taking NBFCs can accept deposits. Other NBFCs, they cannot take deposits from the customers. So their source of funding would be from bank or from various instruments like non-convertible debentures or commercial paper borrowings. We have launched a new course called Static Banking Awareness course. Now this course will be helpful for students who are preparing for the banking exams and for the regulatory body exams. And also recently you would have seen Paytm Bank in news frequently. So when an aspirant reads this news, he would have ample number of questions like what is a payment bank, what are the norms for it, and which is the committee that has launched it. So this static banking awareness course lays a foundation to the current banking and finance news. Now you have to download our AffairsCloud to access this course. Once you have logged into our app, you can go and click this all courses icon, and then you'll be redirected to this page. In this, you have to go and click the static banking awareness course, and under the details tab, you will be able to see a brief about this course. And under the part tab, it will contain all the contents, all the topics of the contents that are currently available in this course. We are working on this continuously, and this will be completed within 2 months. Under the free tab, you can go and access one content, that is the origin and development content, for free. You can go and read this content and have an idea about this course. After reading this content, do attend the quiz that is also available under the same tab. Now, our team has allocated ample amount of time and resources to curate this content. We have created this content from various books and from various verified websites. Our content is better than any book that is available in the market. This is because we update this content on a dynamic basis. For example, there are currently 39 DRTs that are available in the country now. In future, if one more DRT is created or added, then it would become 40. So we would update this content on a dynamic basis. But in case of books, you have to wait for the next publication for this updated content. Nowadays, a lot of practical questions have been asked in the banking exams. For example, how many public sector banks are available on the stock exchange? Which is the payment bank that is being listed on the stock exchange? So we try to cover as many practical questions as possible in this course. Apart from this, we also provide you a question bank that will contain around 3000 questions and the previous year questions along with it. We also have a dedicated tab that will release the important RBI notification and the frequent news released by the RBI. You can use this code B15 to avail 15% discount. This is one of the highest discounts that we have offered until now. So do avail this code B15 while you purchase the course. The next news is about a report that has been released by the Ministry of Finance. The Ministry of Finance released its monthly economic review for November 2024. As per the report, the Indian economy is likely to grow at 6.5% in the financial year 25 compared to the previous projection of 6.5 to 7%. So this is mainly due to the challenges posed by the global uncertainties. The report has cited the Reserve Bank of India's tight monetary policy among the reasons for the slowdown in the first half of the financial year 25. So we know that the GDP growth in the first half of 25 was not that great, and the main reason stated by this report is the global uncertainties. And second is due to the tight monetary policy, because everyone was expecting a rate cut by the RBI in its monetary policy committee meeting, but that did not happen. So the Ministry of Finance stated that the tight monetary policy was also one of the reasons for the slowdown in the first half of the financial year 25. Positive outlook for the second half of financial year 25. So if you see, the report mentioned that factors like increase in the minimum support price for the rabi crops, a high reservoir level, and adequate fertilizer availability will support the sowing of the rabi crops. And also, the report showed that the rural demand remains resilient as the sales of 2- and 3-wheeler and domestic tractor have increased by 23% and 9% respectively. And also, the report further highlighted that the urban demand is also increasing, with passenger vehicle sales registering year-on-year growth of 13.4% in October to November 2024, and also the domestic passenger traffic registering a robust growth. So you see that the second half of financial 25 is expected to go further than the first half of 25. One main reasons are minimum support price, high reservoir level, adequate fertilizer, and also there has been a very good demand that has been shown in the rural side and as well as in the urban side. So the consumption is going to be greater or higher than the first half, and so the GDP projection is higher than the first half. Next is RBI's new guidelines for the closure of dormant account, inactive and zero balance account with effect from January 1st, 2025. So RBI has issued new guidelines starting from January 1st, 2025 for these three types of accounts. So if you see, these are dormant accounts, inactive accounts and zero balance accounts. Dormant accounts are the accounts that have not seen any transaction activity for continuous 2 years or more. And inactive accounts, they have remained inactive for 12 months or longer and will be closed unless reactivated by the account holder. Last one, zero balance, is that the account have maintained a zero balance for an extended period, will be closed. So if you see, why are these accounts have to be closed? So why can't they just remain like how they are till now? That is because these accounts are highly susceptible to fraudulent activities as they tend to be neglected by their holders. So 2 years there is no transaction activity. If a fraudulent person comes to know about this, then he will use this account and use it for illegal transaction. So there is a greater risk of this fraudulent activities in these dormant accounts. That is why if it is remaining inactive, that is no transaction activity for 2 years or more, then it is good to be closed. Next is again inactive accounts. They have been inactive for 12 months. It can be reactivated when the account holder comes and provides the KYC and does a transaction. Here again, the aim is to reduce banking inefficiency and to minimize the risk related to online fraud. The last one, zero balance account. These accounts serve little purpose and may be vulnerable to misuse. The closure helps to streamline operation and ensure compliance with KYC norms. So if you have opened an account, yes, there are zero balance account. That is, you can maintain zero balance, but it should not always be in zero balance, right? These accounts are what this account, zero balance accounts, means that there have been no transaction. Like when there is some credit, when your salary gets credited, and when you take the money, the entire money next day itself for your other purposes, that is okay. But when you have not deposited any money at all since the opening, then that is not good, because it will also be vulnerable, because many people may use it thinking that this account has not been used for a long time, so fraudulent people can misuse these accounts. So that is why when this zero balance account has been for zero balance for an extended period, then it has to be closed. Steps to avoid closure for account holders. So in order to reactivate inactive accounts, ensure at least one transaction is carried out if the account has been inactive for over 12 months. In case of dormant account, visit the branch to reactivate accounts which have been dormant for 2 years. And to maintain a positive balance, avoid keeping an account with a zero balance for long periods. And also RBI's new FD rules. So the RBI also introduced new guidelines for the fixed deposits with the NBFCs and housing finance companies. So let us look at the changes. So for small deposits up to ₹10,000, depositors can withdraw the entire amount within 3 months of deposit without interest. And for large deposits, partial deposits of up to 50% of the principal amount or ₹5 lakh, whichever is lower, are allowed within 3 months without interest. So there will be a maturity, NBFC, not all NBFC can take deposits, only the deposit taking NBFC can take the deposit, and they offer only term deposits. Okay, no savings or current account is offered by the NBFCs, only term deposits, that is only time deposits is offered by the NBFCs. So if you see, it is fixed, but if you want to take the amount before the maturity, then these are the withdrawal rules. So these changes include revised premature withdrawal. So if the deposit is up to 10,000, then you can withdraw the entire amount within 3 months, but you will not get the interest. If it is for larger deposits, then the partial withdrawal of up to 50% of the principal or 5 lakh, whichever is lower, is allowed within 3 months without interest. Again, this is also without interest. Additionally, in cases of critical illness, depositors can withdraw the entire principal amount prematurely, again without interest, regardless of the deposit term. So whatever be the deposit sum, 5 years or 6 years or 7 years, you can withdraw the entire amount without any interest in case of critical illness. Next is, furthermore, NBFC will now notify the deposits of the maturity details at least 2 weeks before the maturity date. Say suppose your term deposit is getting matured by 20th. So it has to be informed at least by or before 6th of that month. So at least 2 weeks before the maturity date, it should be informed the customers. The next news is a very important report that is released by RBI. So RBI released the Financial Stability Report December 2024. So this report is released twice a year and it's a very, very important report. So this FSR is a biannual report released by the RBI in June and December. So remember, when it's been released, it is released in June and December. The report is prepared by the Financial Stability Unit and is a joint evaluation by the subcommittee of the Financial Stability and the Development Council. The report takes inputs from various financial sector regulators like RBI, SEBI, IRDAI, PFRDA and Ministry of Finance. So basically, this report will analyze the current situation of the banking system, whether the entire financial system, not just the banking system, the entire financial system, whether it is resilient to the risk or not. If any major risk happens in the future, whether it can withstand the risk or not. So that is what it analyzes. The report assesses the financial system's resilience and the risk to the financial stability. So the RBI published its first FSR report in 2010. The report covered both, it covered both international and domestic economic conditions, the performance of scheduled commercial banks, NBFC and insurance sector. The report observed that the scheduled commercial banks has been strengthened by the strong profitability, decreasing NPA and sufficient capital and liquidity buffers. So what are the major findings? So as per this report, the Indian economy is demonstrating strength and resilience, and it is projected that the GDP will grow at the rate of 6.6% in the financial year 25. And also, the growth will be mainly driven by resurgence in rural consumption, increase in the government spending and investment, then robust exports, declining NPA and adequate capital. So these will be the main reason for the growth of the GDP. The report highlighted that the India's GDP moderated to 6% during the first half of the financial year 25 from 8.2% and 8.1% in the first and second half of financial year 24 respectively. So if you see, the first half of 25 did not seem a great growth. It was actually comparatively lesser compared to the previous year. The central government's debt to GDP ratio is expected to decrease to 56.8% from 62%, and the state's outstanding liabilities are projected to decline from 31% to 28%. Remember, it is projected the central government debt to GDP is expected to decrease to 56%, and state's liability is expected to decrease to 28%. The report highlighted that the unhedged external commercial borrowings reached at $65.49 billion, nearly 34.4% of the total debt increased under this avenue. So we know that in many Indian entities, they borrow from outside. External commercial borrowings are nothing but when an Indian entity borrows from any entity that is residing outside India from the foreign companies in the foreign currency, then it is an external commercial borrowing. So this is one of the avenue for borrowing. So that has increased, not just Indian companies or startups, even NBFC, they borrow from the external commercial borrowing. So what is this unhedged? So we know that hedging, it is a process of reducing the risk of loss. So say suppose you have bought a house, okay, from a home loan. That time you will mostly be asked to buy a home loan insurance also. Why? If something happens to the house, say some fire accident happens and it causes damage to the house. Now, if you do not have an insurance, then you have to put in your money and construct the house. But if you have an insurance, the insurance will cover up the cost in rebuilding the damaged property. So that is why an insurance, it also acts as a hedging instrument. That is what is mentioned here. Hedging is the process of one asset with the intention hedging is the purchase of one asset with the intention of reducing the risk of loss from another asset. So if you want to reduce the loss of the house, you have to buy an insurance, housing insurance. So for example, when you get homeowners insurance, you are protecting yourself against fires, break-ins and other unanticipated calamities. In this case, if you see, increase in foreign currency borrowings by the NBFC could potentially pose currency risk to the extent they are unhedged. So when these external commercial borrowings are unhedged, suppose now they are borrowing $100 million, okay, and say the currency $1 is suppose 70 rupees today, okay, 80 rupees today. They have to return this after say 2-3 years. That time the same 100 million will cost more if the dollar rate goes up to 100 rupees. If $1 becomes 100 rupees, then there will be a foreign currency risk. So that is why hedging is very important. Next is monetary penalties imposed by the RBI on the regulated entities from June to November 2024 have decreased by 47%, that is to 30 crores. So out of the 153 monetary penalties, if you see, 5 is on public sector banks, 5 on private sector, 3 foreign banks, 2 on regional rural banks, and 116 monetary penalties on the cooperative banks, 14 monetary penalties on the NBFC, and 8 monetary penalties on the housing finance companies. So here the thing you have to remember here is the maximum monetary penalty has been imposed on the cooperative banks, the least have been imposed on the regional rural bank. Just remember this, you don't have to remember all the numbers, just remember that the maximum penalty has been imposed on the cooperative, the least penalty has been imposed on the regional rural bank. So as of December 2024, the liquidity deficit stood at 2.43 trillion rupees. So in December, there was a liquidity deficit condition in the banking system. So main reason for that is tax outflows and also central bank's foreign exchange intervention. So foreign exchange intervention is required in order to reduce or in order to avoid rupee from depreciating. Next is India's gross NPA ratio declined to a 12-year low, that is to 2.6% in September 2024. The gross NPA decreased to 2.6% in September 2024 and the net NPA, it remained at around 0.6%. So if you see in this, the macro tests are performed. So they will check that whether the bank will be able to sustain any scenario when there is adverse stress. So if you see, that is what is done in this macro test. They will check whether the bank can exist in various type of scenarios, various type of stress scenarios. That is what is done in this macro test. The macro tests are performed to assess, macro stress tests are performed to assess the resilience of the scheduled commercial bank's balance sheet to unforeseen shocks emanating from the macroeconomic environment. So here it has been tested under 3 scenarios. One is baseline, second adverse scenario 1 and the third is adverse scenario 2. So here baseline, it is derived from the forecasted path of macroeconomic variables. So whatever is the current situation, from there a forecast will be done depending upon the macroeconomic variable. In that, this test will be performed. Next is adverse scenario. It is a scenario that assumes persisting geopolitical risk, escalation of the global financial market volatility. The third, adverse scenario 2, it is a test where the condition is that a synchronized sharp growth slowdown in the key economies happens due to global and idiosyncratic risk factors. So due to this, a growth slowdown happens. So in various scenarios, how is the balance sheet of the scheduled commercial banks? So if you see in these various scenarios, it is observed that the gross NPA ratio, it would possibly increase to 3% in case of baseline scenario, and in case of adverse scenario 1 and 2, it is expected to increase to 5% to maximum 5.3%. This is in case of gross NPA. Similarly, in case of capital adequacy ratio, if you see currently in September 2024, it is maintained at 16.6%. It is expected to reduce to 16.5% in the baseline scenario, and in adverse scenario 1, 14.3 and adverse scenario 2, 15.7. Next is provision coverage ratio. So the provision coverage ratio of scheduled commercial bank increased further to 77% in the September 2024. So what is this provision coverage ratio? So it is nothing but the how much of provision you have done to a NPA. Say suppose the NPA is 100 crores and you have provision for 70 crores. Then that means that the provision coverage ratio is 70%. This is what is the provisioning coverage ratio. The next point is about the key risk indicators framework. So if you see currently this data was released at the start of 2014, 75% of the 33 public and private sector banks examined under this KRI framework were found deficient in 3 or more KRIs. So there was a KRI framework that was set up, and in that 33 banks were put into examination. In that 33 banks, around 75 banks were found deficient in 3 or more KRI indicators. Now, what is this KRI framework? Now, what is this KRI framework? This framework, it was formulated by the International Monetary Fund, which measures the vulnerability of the banks by merging the Camel supervisory framework with the market-based metrics. The Camel supervisory framework is nothing but it evaluates 5 indicators. Here, if you see, the framework evaluates the bank's overall risk based on 5 indicators. Those are capital adequacy, asset quality, profits, liquidity, and market metrics. So these are the 5 indicators that have been evaluated. So if you see at 2014, there were 33 banks that were put under monitoring under this KRI framework. In that, if you see, they have told that 3/4 of this 33 banks, they have been deficient in more than 3 KRI indicators. But now, if you see, only 3 banks have been deficient in exactly 3 KRI indicators, so which is a huge improvement. From 3/4 of 33, now it has been reduced to just 3 banks. The report noted that only 3 banks accounting for 15% of the total banking system assets have been found to be deficient in 3 KRIs in September 2024, and none are flat deficient in more than 3 KRIs. The next news is a report released by the IRDAI. So the claims ratio of the non-life insurers declined to 82.5% in the financial year 24. Now, before moving into the details of the report, we should know the difference between incurred claim ratio and claim settlement ratio. So, if you see incurred claim ratio, it is the ratio of the total value of claims settled by an insurer to the total value of premiums collected by the insurance company in a given period. So, if you see, if an ICR of 85% is there, it means for every 100 rupees of premium, the company is paying rupees 85 towards claim settlement. So remember, if it is 85% of ICR, incurred claim ratio, then for every 100 rupees of premium, 85 rupees is paid as the claim settlement. In case of claim settlement ratio, number of claims settled to the number of claims made. So if you see, if CSR is 85%, then it means that 85 out of every claims have been honored. Out of every 100 claims have been honored. So if there are 100 claims that have been submitted by the customers, then 85 have been honored. This is the difference between incurred claim ratio and claim settlement ratio. So if you see the claims ratio, that is the net incurred claims to the net earned premium, that has been decreased to 82.52% compared to the previous year of 82.95%. So if you see, a slight decrease has been observed in this claims ratio. But if you look at the total premium that is being collected under the non-life insurance, it has been increased by 12% compared to the previous financial year 23. So the increase is by 12.76%. That is, the total premium collected is 2.9 lakh crore in financial year 24. Here, non-life insurance, here it includes vehicle, health. So all this comes under the non-life insurance, and the total premium collected here is 2.9 lakh crore. So if you see under the insurance, the penetration has reduced compared to the previous year. The previous year, the penetration observed was 4%, but now it has been reduced to 3.7%, which is quite saddening. So out of the total contribution of the insurance of the premium amount, if you see, the contribution of the public sector general insurance was around 82,000 in the previous year financial 23, and now it has been increased to 90,000 crore. And in case of private sector insurance, it has been increased to 1.88 lakh crore. So the contribution from the private sector is more than that of the public sector. And also the incurred claims ratio, if you see, it is more in public sector compared to private sector. Remember, the premium contribution is more in private sector, but the claims ratio is more in the public sector. So in public sector, if you see, it is 97.23%, and in the private sector, it is 76.49%. The life insurance paid total benefits of 5.77 trillion in financial year 24, accounting for 70% of the net premium. So if they had received 100 rupees as the premium, net premium, then they have settled 70 rupees. as benefit to the customers. So if you see, out of the life insurance company, 18 companies have been profitable this year. Next is the total industry investment reached 67 lakh crore. So we know that the insurance, they collect premium from the customers, and from that premium they make investments. So from the investments they again use the money to clear the settlements or claims. So this is how the insurance industry works. So if you see, the total industry investment reached 67 lakh crore compared to the previous 60 lakh crore. So there has been an increase of 12.6%. So out of the investment, here if you see, the life insurer has the majority contribution. So out of the total investment, life insurance accounts for 91%, general insurer accounts for 7%, and reinsurer accounts for 1.9%. Similarly, in case of public sector and private sector contributes around 31% to the investment and 69% is from the public sector. Majority is from the public sector. So as per the report, the general health insurance settled 2.7 crore health insurance claims worth rupees 83,493 crores, and apart from health insurance, general insurance paid around 1 lakh crore in claims. So the major findings, if you see, there has been a decrease in the insurance penetration. This is very saddening. From 4%, it has reduced to 3.7%. The overall India's insurance penetration declined for a second consecutive year, that is to 3.7% from 4%. And that the life insurance penetration that saw a marginal decrease. So if you see, there are two, life insurance and non-life insurance, and life insurance saw a marginal decrease to 2.8%, whereas the non-life insurance penetration remained stable at 1%. And if you see, there is a marginal increase in the insurance density. So insurance density is nothing but the total amount of premium collected divided by the country population. This is what is insurance density. So if you see the insurance density, it has increased slightly from $92 in the financial 22 to $95 in financial 23. The life insurance density remained steady at $70, while the non-life insurance density increased from $22 to $25 in the financial 24. Next is the increase in the insurance premium. The report revealed that the total premiums across all insurance category reached around 11.19 trillion in the financial year 24. So if you remember, out of this 11.19 trillion, non-life insurance premium is around 2.9 trillion. And if you see, the remaining premium income of the life insurance industry reached 8.3 trillion in the financial year 24, marking just a 6.1% increase compared to the previous year, and it is much slower than the GDP growth. And the private sector life insurers registered 15.1% growth in the premium compared to way more than the public sector growth, which is just 0.2%. So the registered growth in the premium was 15% by private sector and just 0.2% by the public sector. And the total premium amount collected in the financial 24 was 11.19 trillion. From that, non-life insurance 2.9 trillion and life insurance 8.3 trillion. The next news is about a loan agreement between India and ADB. So India and Asian Development Bank signs a $500 million loan agreement to support the sustainable infrastructure projects in India. So this money will be used to support green and sustainable infrastructure projects aligned with the India's climate commitments. So this agreement, if you see, it is part of the financing environmentally sustainable growth in the infrastructure project. So this project will prioritize energy transition and connectivity as well as the underserved industries, including urban projects, education and healthcare. Remember, the loan amount involved is $500 million. It is between Government of India and Asian Development Bank. It will be used for green and sustainable infrastructure project. Next is ADB, that is Asian Development Bank, and Vastu Housing Finance Corporation. They have entered into a loan agreement of $70 million to access affordable and sustainable housing loans. So this financing, it will be used to provide loans to the economically weaker section and the low income groups and the women borrowers. So here there are three beneficiaries. One is EWS, Second is low income, and the third one is women borrowers. So out of the total funds, 15% of the total funds will be given to the first time borrowers. So by focusing on the lower income households and sustainable building, the ADB aims to address India's severe housing shortage and also promote environmentally friendly housing that improves climate resilience for the homeowners. Next is about the rating. India Ratings and Research released its financial 26 macroeconomic outlook, and in that it has projected that India will grow at 6.6% in the financial year 26, and the expected inflation rate will be around 4.4% in the financial year 26. And also it has forecasted that the merchandise trade deficit will be of $308 billion, which means trade deficit means import will be more than the export. Only then a trade deficit happens. When the export is more than the import, then a surplus happens. Okay. Next is RBI constituted a 8-member committee to develop framework on ethical use of AI in the financial sector. You know that now the private sector and also the public sector banks, they are making use of AI in their system, like for credit appraisals. In order to give loans to the customers, they have to first appraise them, right? You have to analyze the loan, analyze the customer. So it is the credit appraisal. This is what is called as credit appraisal. So AI is used in the credit appraisal. It is also used in fraud detection. So banks have started using or applying artificial intelligence in fraud detection, in credit appraisal. So these many various application of AI in the banking sector is already occurring. So in order to ensure that the ethical use of AI happens, this framework has been formed. So RBI announced that it has constituted an 8-member committee to develop a framework for responsible and ethical enablement of artificial intelligence in the financial sector. So this committee will be chaired by Pushpak Bhattacharya, who is a professor from the Department of Commerce, Science and Engineering, IIT Bombay. So he is a professor from IIT Bombay. He will be chairing this 8-member committee. Remember, it is Framework for Responsible and Ethical Enablement of Artificial Intelligence. So it will recommend a framework including governance feature for responsible ethical adoption of AI models in the Indian financial sector. Next is ICICI Prudential Life Insurance has launched ICICI Pru-Wish for women specific illnesses. So this product, if you see, it is in partnership with the Reinsurance Group of America, and it will provide a lump sum payout upon diagnosis of covered conditions. So this is the life insurance industry's first health product addressing women-specific ailments. It also includes coverage options for maternity-related complications and genetic disorders in newborns. So remember, it is ICICI Pru-Wish. This is the name of the plan that has been launched by the ICICI Prudential and Reinsurance Group of America. Next is the HSBC Taj credit card was launched in collaboration with the Indian Hotels Company Limited and the Visitors International Stay Admission, that is Visa. So if you see, Visa and Indian Hotels Company Limited together, they have launched this HSBC Taj credit card. So this card offers exclusive benefits for those who value premium hospitality, luxury travel and personalized services. The joining fee is 1,10,000 and also the annual fee is also 1,10,000. Next is about an appointment. So Jammu and Kashmir J&K Bank Limited has appointed Amitava Chatterjee as its new MD and CEO for a period of 3 years with effect from 30th December 2024. So if you see, he is currently serving as the Deputy Managing Director of the State Bank of India and has previously held the position of MD and CEO at SBI Capital Market Limited. So he has an extensive banking career of over 30 years of experience. So remember, the name is Amitav Chatterjee. He will be the MD and CEO of J&K Bank. Next is about IFSCA. So IFSCA has released the revised framework for setting up the operation of ITFS, that is International Trade Financing Services Platform, which is in the GIFT City. So what is this ITFS? So this ITFS platforms are regulated platforms that provide trade finance. So remember, it provides trade finance services to the exporters and importers globally. So these platforms are set up in the IFSC to help bridge the financing gap for the trade. So exporters and importers are in need of finance, right? So this IFS will help in providing the finance services to the exporters and the importers. So what are the changes that have been brought in? First is on-tap registration process. The process of registration for eligible entities can be run to an on-tap basis. On-tap basis means it will be available throughout the year. So anytime the entity can avail for a license. That is what this means. On-tap means it is available throughout the year. Next is permissible activities. This will now include secondary market transaction of the trade finance units. So by including the secondary market transaction, the liquidity in the market will increase. That is, more people will be there, right? Primary market is when the first time issuance of securities takes place. Secondary market is when the security trading takes place. So when this security market transaction of trade finance units is introduced, the liquidity on the platform increases. That is one main reason. Next is eligible participants. In addition to previous list of eligible participants like financiers, exporters, importers, new people like payment service providers will also be included, which will enable easier access for participants to provide currency exchange, receive payments in their local currency in a time-bound manner. Next is expanding the scope of financiers. So as per the previous guidelines, the list of eligible financiers include banking units in IFSC or finance companies or units licensed, regulated or registered by the IFSCA or other financial sector regulators either in India or abroad. So these are the various financiers that are now in the IFSC. Now, if you say they have planned to expand the scope to include factors registered under the Factoring Registration Act. So now even factors will be included as a financier in IFSC. So what is a factor? If you see, say a company A has sold goods to this person. Okay, so they have sold the goods on credit, which means that they have sold on this day first, but B has promised that I will give you the money on 30th. So there are around 30 days gap, right? But the company wants the money now. So what the company does is that it goes and produces the bill to the factor. Okay, it tells that I want the money now. You give me some money. You give me the money now, and you can collect the money from the customer B after 30 days. So say the cost of the goods is 100 rupees. So the company produces the bill to the factor, and the factor will give 95 rupees. Okay, and then on the 30th day, the factor will collect the 100 rupees from the debtor. So this 5 rupees is the profit that's been earned by the factor. So remember, this is what factor is. Now this factor will be included as a financier in the IFSC. Next is Central Bank of Sri Lanka imposed penalty on Indian Bank for non-compliance. So a penalty of 5.85 lakhs has been imposed on the Indian Bank Limited, which is headquartered in Tamil Nadu, Chennai. So for not complying with the provisions of Sri Lanka's Financial Transaction Reporting Act number 6 of 2006. So if you see, there are two branches of Indian Bank in Sri Lanka, that is in Jaffna and Colombo. Remember, the amount is 5.85 lakhs that has been imposed on the Indian Bank by the Central Bank of Sri Lanka. Next is ICICI Bank Limited and Times Internet has launched Times Black ICICI Bank Credit Card. So this is a co-branded metal card offering high net worth individuals exclusive travel benefits, luxury lifestyle services and privileges for exceptional experiences. So the card holders will earn 2.5% reward points on the international spends and 2% on the domestic purchase. So remember, this card is jointly launched by Times Internet and ICICI Bank Limited for the affluent community. Next is Bajaj Allianz General Insurance has launched two motor insurance add-ons. The first is Eco Assure Repair Protection. The second one is Named Driver Cover. So this Eco Assure Repair Protection, it focuses on eco-friendly vehicle repairs and replacement, ensuring both sustainability and high quality service. It is available for private cars up to 12 years old, and in case of Named Driver Cover, it is tailored for individuals owning one or multiple cars driven primarily by specific individuals. You see, the affluent people, they have multiple cars and each car may be driven by separate drivers. So for them, this cover will be useful. So it introduces greater flexibility and protection by providing its own damage cover based on a named driver. So next news is M2P Fintech will enable SBI to strengthen its prepaid offerings with advanced features such as real-time tracking, instant card issuance, and enhanced fraud prevention mechanism. So we know that prepaid instruments, prepaid payment systems are nothing but they are cards or wallets which will have money loaded in them before they have been issued. So if you want a prepaid instrument, if you want to use a prepaid instrument, you have to have money into it. So first you will load the money from your bank account into this prepaid instrument, and then you use it for various purposes to buy goods or services from the merchants. This is the purpose of a prepaid instrument. So this collaboration aligns with the goal of digital transformation in India's payment infrastructure, contributing to the financial inclusion and supporting the government's push for the cashless economy. So remember, it is M2P Fintech that will enable this offer to the SBI. Next is Shriram Finance launches new vertical called Green Finance for rupees 5,000 crore asset under management. So this amount will be used for funding solution for sustainable business across India. So initially the company will focus on building the EV portfolio in states like Karnataka, Kerala, NCR and the Maharashtra, that is Delhi and Maharashtra. Next, if you see, the primary goal of Shriram Green Finance is to achieve an asset under management of 5,000 crore within the next 3 to 4 years. Remember, it is Green Finance vertical by Shriram Finance, and the amount involved here is 5,000 crore. Next is Aditya Birla Capital becomes the first BFSI, that is Banking, Financial Services and Insurance Company, to offer all financial services on the ONDC network, that is Open Network for Digital Commerce Platform. So if you see, ONDC is a network of interconnected e-marketplaces through which sellers, including brands, can list and sell their products directly to the customers, bypassing any middlemen or intermediaries. So it allows transitioning from a platform-centric model. So if you see in Amazon or Flipkart, there will be certain sellers registered with this platform. Only those sellers can come and sell the products. Similarly, if you find a product in Amazon, but if you are not a registered customer in the Amazon, you cannot buy it from the Amazon. But here, ONDC platform, it is an open network. So here, all sellers can come into this platform and sell their products. So it is a convenient that is offered to these sellers, and also it is convenient for the customers as well. So remember, Aditya Birla Capital, it becomes the first company to offer all the financial services on the ONDC, first BFSI company. Next is Yes Bank and FICCI, Federation of Indian Chambers of Commerce and Industry, has launched Yes Power Up to promote the women entrepreneurship. So this is a specialized MSME program designed to empower the women entrepreneurs in promoting their business. So if you see, what are the offers that have been given under this program is that SME loans, it will offer comprehensive funding solution like waiving 50% of the processing fee for the members of FICCI FLO, and also Yes First Business Account. So it will provide premium transactional accounts with exclusive benefits for women entrepreneurs, and also eligible women entrepreneurs will get access to international markets with various trade and forex solutions. The last one is beneficiaries will be able to trade maximum rupees 1.5 crore at zero brokerage for 60 days with Yes Securities. So these are the various offers under this program. Next is about an appointment. So Rajit Verma has been appointed as the CEO of the DBS Bank India Limited. It is a subsidiary of the Singapore-based DBS Group. So he is an experienced banker with 27 years of expertise in areas like consumer, corporate banking, transaction banking, financial institutions, sustainable finance, and also SME banking. So if you see, in 2019, this DBS Bank announced the launch of DBIL, that is DBS Bank India Limited, which was the first large foreign bank in India to operate as a wholly owned subsidiary of a global bank. DBIL has expanded to over 350 locations across 19 states in India. So remember the name, the new CEO of DBS Bank India Limited is Rajit Verma. Thank you for watching the session. I hope you had enjoyed it. We're also available in Telegram under the name AffairsCloud_official. We also have an Instagram handle. Apart from this, you can contact us directly on 9677333862 regarding any courses that we offer, or regarding any payment issues. You can contact directly on this number. Thank you.